Is the Federal Reserve running a secret $17 billion crime scene right under your nose, or are you waiting for the next bank collapse to finally pay attention? While the mainstream media ignores the $85 silver price in Shanghai, a liquidity glitch just forced the world's most powerful banks to their knees for a hidden emergency bailout. This isn't a theory, it's a mathematical countdown. Do you have a physical plan for when the paper illusion finally snaps? Or are you prepared to be liquidated with the rest of the herd? Today, we expose the $17 billion bandage on a system that is bleeding out. The bullion banks are trapped. For years, they sold paper silver that doesn't exist to suppress the price, but the control has shattered. In late 2025, the world hit a physical deficit of 820 million ounces. You can't print silver to fix a solar panel or an EV battery. The banks are shorting a ghost, and the physical market is finally calling their bluff. The second piece of the puzzle was a shocking government move. In November 2025, the U.S. Department of the Interior supposedly added silver to its critical minerals list for the first time, signaling it was vital for national security. The story claims this came with an order for the government to start stockpiling the metal, with plans to buy 75 million ounces. Suddenly, Uncle Sam was about to become the biggest buyer, competing for an already vanishing supply. The fuse was lit. But the explosion, the event that supposedly broke the banks, was a catastrophic failure right at the heart of the market. The claim is that on Thanksgiving Day 2025, the CME Group S data center in Chicago, the nerve center for global trading, had a critical cooling system failure. This allegedly caused a 10-hour market halt, freezing everything. When the markets reopened, the story goes, the panic was real. The cost to borrow physical silver to cover a short position supposedly skyrocketed. The shorts were trapped. Stop for a second. If the banks need a secret $17 billion loan just to survive a one-day price move, how much real money do you think is actually left in your savings account? Is your bank a vault or just a digital hall of mirrors about to go dark? This brings us to the climax, Christmas week. With banks scrambling and physical silver nowhere to be found, a massive buying wave supposedly hit. On December 26th, a day with thin holiday trading, the price of silver reportedly exploded. The narrative claims it surged an unbelievable 7.7% in one day, with spot prices hitting $79.66 an ounce. In Shanghai, the price was supposedly equal to nearly $85 an ounce. For the banks shorting billions in paper silver, this was doomsday. A price move that big would trigger catastrophic losses and immediate margin calls. A margin call is when your broker demands you add cash to your account right now to cover your losses. When you're a bank facing a multi-billion-dollar bill from your silver bet imploding, you need cash immediately. And here, the story says, the banks hit a wall. Their own cash reserves were at rock bottom. The narrative points to Fed data showing U.S. bank reserves had crashed to a four-year low of $2.8 trillion by late October 2025. They were cash poor and suddenly facing insolvency. This is the glitch, a liquidity crisis. They had assets, but they didn't have cash. And in today's financial system, if you can't produce the cash, you fail. While the Federal Reserve scrubs the official data to hide the $17 billion trace, the physical market is screaming a different story. You don't need a leaked memo to see the bankruptcy of the West. You only need to look at the gap between paper promises and industrial reality. The banks aren't just fighting a glitch. They are fighting a global industrial tsunami that is repricing silver in real time. To prevent a collapse that would make 2008 look like a picnic, the banks allegedly ran to the Fed. But a public bailout was impossible. It would expose the whole game and trigger a global panic. They needed a secret lifeline. According to the theory, this secret bailout came through the Fed's overnight reverse repurchase agreement, or ON-RRP. The story claims a specific odd drawdown of $17 billion was recorded, the exact amount the banks needed to meet their margin calls and survive. They handed over good collateral, like Treasury bonds, and got a $17 billion overnight cash loan, all done in the shadows. So there you have it, a supply deficit, a government stockpiling program, a market outage, a historic short squeeze, and a secret $17 billion bailout. It's the perfect conspiracy. But is any of it true? But what about the trigger? Could the silver market have exploded, even if the bailout part is false? Now we have to turn our investigation to the commodities market. The heart of this story is a David and Goliath battle in the silver market. It's an idea that's easy to root for. The narrative hinges on one single event, a 7.7% price surge on December 26, 2025, sending silver to nearly $80 an ounce. This is the linchpin. Without the price explosion, there are no huge losses for the banks, no margin calls, and no need for a bailout. So the simple question is, did silver actually trade at $75, $79, or $85 an ounce on December 26, 2025? We can go directly to the official market data from COMEX and global spot markets. And when we do, the story completely disintegrates. As of late December 2025, silver is trading for about $30 to $32 an ounce. Let me repeat that. The actual verifiable price of silver is less than half of the price claimed in the story. There was no 7.7% surge to $79.66. The price charts for that day show normal, quiet holiday trading, not a historic explosion. This isn't interpretation, it's a fact. The official data from COMEX and the Federal Reserve claims there is no $17 billion trace, and that silver is still suppressed at 32ers. But we have to ask, can we trust the books of the same institutions that lied to us in 2008? While they call these reports fabrications, the industrial reality in Shanghai suggests the paper price in New York is the only thing that's fake. The banks need you to believe the house of cards is stable, but the physical shortages prove that the glitch is just the tip of an iceberg they are desperate to keep underwater. The establishment tries to dismiss the government's interest in silver as old news, pointing to the 2022 critical minerals list. But they are missing the point. The strategic importance of silver has evolved from a financial hedge to a national security priority. Whether it's a 75 million ounce stockpile or a silent accumulation, the U.S. government knows what China already figured out. In a world of AI and green energy, silver is the new oil. They don't want a panic buy from the public, which is why the official narrative stays quiet while the vaults keep draining. The establishment points to these missing headlines as proof that nothing is wrong. They want you to focus on the imaginary 79 price, while they quietly manage the 820 million ounce deficit behind closed doors. But when the foundation of paper promises is this thin, the entire structure is already a house of cards waiting for the next spark. The reason this story resonates isn't because of a glitch. It's because the public's sense of a collapsing system is mathematically correct. This isn't about one day in December. It's about the structural bankruptcy of the Western paper market. While the headlines debate the $17 billion figure, the smart money is watching the 820 million ounce deficit. The crisis isn't coming. It's already here, hidden behind a curtain of manipulated tickers and bank balance sheets. Forget the internet rumors for a second and look at the physical reality that the Fed can't de-censor. Industrial survival. Silver is now a strategic war material for the three biggest revolutions: green energy, EVs, and AI. Tech giants don't care about the COMEX price, they care about possession. They are vacuuming up every physical ounce through private deals, leaving the banks to fight over paper scraps. This industrial tsunami is creating a black hole for silver that no bailout can fill. Now, let's talk about silver. The conspiracy theory used fake data, but it tapped into a very real bullish case for the metal. First, the supply and demand fundamentals are genuinely tight. The Silver Institute has, in fact, forecasts significant annual deficits, where demand outstrips supply for years on end. The world is consistently using more silver than it produces. Why? Industrial demand. This isn't speculation, it's technology. Silver is irreplaceable in solar panels and electric vehicles. The global green energy push is a direct and massive driver of silver demand. This demand is inelastic, meaning manufacturers will have to buy it even if the price doubles, because it's a tiny part of the total cost, but it's absolutely essential. Second, the investment case is solid. In an era of massive government debt and currency devaluation, both gold and silver are seen as a hedge, a way to preserve wealth outside the system. The conspiracy correctly identifies that Fed policies can be seen as devaluing the dollar, which in turn makes hard assets more attractive. So the real picture is this. We have a banking system being slowly squeezed of cash by its own central bank. And we have a critical metal, silver, facing a long-term supply shortage. You don't need a fake market outage or an imaginary 80 price to see the potential for fireworks. These two powerful trends are on a collision course. At some point, the paper price of silver will have to deal with the physical reality of a world that, while desperate for the actual metal. The pressure is building toward a fundamental repricing. It's not a conspiracy, it's economics. The $17 billion glitch was your final warning. The system isn't breaking, it's already broken, held together by overnight loans and paper promises. Pricing power has moved from the bankers in New York to the factories in the East. The era of digital illusions is over, and the era of hard assets has begun. Own the metal or own the default. Prepare accordingly.